Imagine waking up on January 1st, 2026. You have $0 in assets, no stocks, no investments, maybe just some debt and a paycheck that barely covers the bills. Meanwhile, the internet is screaming about AI replacing jobs, expensive housing, and economic uncertainty. Most people freeze here. They assume the game is rigged, so they never even start. But if I had to start from absolute zero today, knowing everything I know about money, investing, and human psychology, I wouldn't panic, because building wealth is actually much simpler than people think. Not easy, but simple. And if I were starting over in 2026, this is the exact blueprint I would follow. First, I wouldn't invest a single dollar. That surprises people, because everyone online tells you to buy stocks immediately. But if you're sitting on high-interest debt, you're not investing. You're drowning. A 20% credit card interest rate destroys wealth faster than most investments can build it. So before I touch the stock market, I become a debt destroyer. Every extra dollar goes toward the highest interest debt first. Not because it feels exciting, but because mathematically, it's the smartest move possible. And here's the thing most people don't realize. Debt doesn't just hurt your bank account. It destroys your confidence. When you owe money, you become scared. Scared to leave your job. Scared to negotiate. Scared to take risks. Paying off debt isn't just financial. It's psychological freedom. Now, once the toxic debt is gone, most people rush into investing. That's another mistake. Because life always happens. Cars break. People lose jobs. Medical emergencies appear out of nowhere. And if all your money is trapped inside investments when disaster hits, you're forced to sell at the worst possible moment. That's why the next step is building a cash buffer. Not for growth, for survival. 3 to 6 months of basic living expenses. Rent, food, transportation, utilities. That emergency fund changes your psychology completely. You stop making desperate decisions. You stop panicking during market crashes. You finally gain breathing room. And only after that do I start investing. But here's where most beginners get distracted. They try to find the next Tesla, the next Bitcoin, the next stock that will explode overnight. The problem is, professional investors with billion-dollar resources fail to beat the market consistently. So, the average person trying to outsmart everyone on a phone app? The odds are terrible. That's why my strategy is boring. And boring is powerful. I would put most of my money into low-cost index funds. Simple, automatic, long-term. Because real wealth usually comes from consistency, not excitement. The truth is, good investing should feel boring. If it feels like gambling, it probably is. Now, there's another leak most people ignore: taxes. You can invest perfectly and still lose huge amounts of money simply because your money is sitting in the wrong accounts. That's why tax-advantaged accounts matter. 401s, Roth IRAs, HSAs. These accounts protect your money while it compounds. And over decades, that difference becomes massive. But none of this works fast enough if your income stays low forever. That's the final piece people avoid talking about. You can only cut expenses so much. Eventually, you need to increase your earning power. That means upgrading your skills, learning things that make you more valuable. Communication, sales, technology, management. Whatever creates leverage in your career. Because earning an extra $20,000 a year changes your financial future far more than skipping coffee ever will. That's why wealthy people focus on building a bigger income engine. So if I had to restart from zero in 2026, this would be the entire game plan. First, destroy high-interest debt. Second, build a cash emergency fund. Third, invest consistently into low-cost index funds. Fourth, use tax-advantaged accounts. And finally, spend years increasing your value and income. That's it. No secret hacks, no overnight success. Just discipline, consistency, and time. Because wealth usually isn't built in explosive moments, it's built quietly, month after month, year after year, until one day, you suddenly realize your money is finally working harder than you are. And that's the moment everything changes.